All right, lights, camera, action. It's time to bring in Brett Manning, disguised today on this Halloween as Chart Trader. Good morning, Brett.
Howdy, Jim. Trick or treat.
Trick or treat to you. You got any, this is your first one, actually, for your little ones, isn't it?
No, second.
Oh, second one? Are they
Yeah.
able to, were they able to walk last time?
No. We took them around in a little triple stroller to just kind of meet the neighbors, and they were dressed up like mice. It was adorable.
Oh, yeah,
With giant floppy ears. Actually, rabbits, I think. I don't know. Rabbits or mice. Big ears either way. I think it must be rabbits. Anyways, it was really cute.
Well,
And,
too cute to call them
yeah,
rodents, I'm sure, right?
Yeah, I think so. Yeah, although that would be a good catch-all term.
Yeah, all right. Well, what are they being this year?
Pirates.
Pirates. Oh, can't go wrong with
We're going to be
pirates.
thematic when they're too young to really choose reasonably. We'll be thematic, and then it will turn into something ridiculous.
Are you joining the party as well?
Naturally.
All right. Well, I'm going to look forward to pictures, and hopefully all the listeners will be able to see them tomorrow. Hopefully you'll share, right?
Oh, absolutely.
All right. Well, something to look forward
Not
to.
going to happen.
No. I was actually getting excited. Well, I'll see if I can't twist your arm. We'll make a bet and see if we can't get that. We'll figure something out. All right, Brett. So, very interesting action that we're seeing here in the equity complex. We've got strength pretty much across the board, not only in the U.S. and pretty much all sectors, excluding utilities and staples, but across the globe for the most part. So, what's your 30,000-foot take on this one?
So I think we discussed yesterday a few points that favored this kind of shift. Number one, I think that we just simply had too much aggressive manifest bearishness in the tape. And I mentioned in my notes this morning that there were basically two aspects that really made that clear, I think. One was just something I'd noted a couple times in terms of just watching the tape and the way the order flow was. And I thought yesterday afternoon was a really interesting example of that, when I was noting a possible short setup and then said I was holding off because of what I was seeing in the tape. It just didn't seem like it was going to be a wise risk. Basically, a lot of market orders hitting every time you got a 1, 2, 3, 4 tick move back off of a key level. It was just hammered back down. I mean, big orders coming through and sweeping out like 4 levels of the bid. And when I see that kind of thing, and it's kind of grown up over the last week or so, where that really, I believe, is large shorts that have become larger and larger over the course of this downtrend, become more and more aggressive with higher and higher conviction. And, there's been a lot of synchrony in that type of tactic where you start, you get aggressive hammering orders into the bid in the futures. And you could just knock things through levels, and there's not enough conviction on the long side to hold on, and you just run people out. And we saw that same kind of tactic going on yesterday afternoon in the triangle pattern, attempting to break the S&P down basically under the 2645 to 2650 area, and maybe try to retest that big tail low that we had in place off of the Monday afternoon lows. Mm-hmm. And just watching those orders, it just felt like it just was getting increasingly clear from almost like a negative image view of the stock market, negative like from the art standpoint, like the empty space, the negative space, that there was a really big bid underneath things that was just absorbing this and wasn't aggressive at all. And at a certain point, you just feel like it's getting too crowded on a short time frame. And at the same time, I noted early in the day that one of the big Wall Street prime brokers, one of the biggest prime brokers, came out with a note saying that the percent of gross for hedge fund short interest was at levels that we hadn't seen since 2015. And there was a time in that, if you remember the second half of the year, and I'm sure this is when they were referring to, probably, following the August crash, following the renminbi devaluation, and starting into that period of the real crash leg of the crude oil downtrend, and basically the implosion of the heavy industry side of the market, which is what we saw into the lows in early 2016. During that period, there was such incredible conviction that we'd finally topped the bull market, and we were heading into a more sustained bear market, and that maybe even what we were seeing in energy stocks could be likened to what we saw in the financials in 2008, and et cetera, et cetera, et cetera. That was a period of extraordinary hedge fund interest on the short side, right? I mean, that was a lot of big hedge fund guys coming out with, really high conviction proclamations about, 35%, 40% decline in the S&P, and this measure versus that measure, and this historical, et cetera. A lot of notes like that going around, a lot of research pieces, and a lot of big, heavy shorting from hedge funds. And right now, we're seeing levels that we haven't seen since then. This is comparable. Now, we don't know if it's truly comparable to what we saw then, but there's nothing that's been greater than that in the last several years. So for this entire leg up that emerged out of that 2016 January, February low, this is the most aggressive shorting that we've seen from hedge funds right now. So when you start to see the tape hold up under fire, and you've got a context that's defined that way, then I think, there's no way to not get at least a rebalancing bounce. And I think that's kind of what we're seeing right now. And the one other factor that I brought up is one interesting way to use the put-call ratio is to look at the 10-day average, because you can take historical analysis of that pretty easily. Intraday data is a little tougher to do that with, and you can look over long periods. And one of the levels for a 10-day put-call average that tends to be really significant is above basically 1.15. And when you start to get, and it's really, in declines, you see a lot of 1.08, 1.10, 1.12, but when you get up above 1.15, it's pretty significant. And yesterday, about that time, the 10-day average was floating around above 1.18, and we hadn't seen that since the night before the election in November 2016. So the 10 days leading up to that, the amount of hedging, and you remember that narrative that Trump was starting to catch up in the polls, and people were looking at it like that would actually end up being some terrible thing if you can move your head back to then, as far as just the idea of that process taking place was something people were super hedged about. And we got to a put-call ratio that was pretty close to that on 10-day average yesterday afternoon. And the time before that was the August crash, when everybody wanted to still be in the market, and they weren't sure why the market went down 10% in a couple days. So that was just a massive amount of hedging. So when you get that kind of caution mixed with that kind of shorting, it's really hard to not get some kind of reaction bounce. And I think we're in the process of playing that out right now. Doesn't necessarily mean it's going to be any kind of long-term low, but, if what's around the next corner is a little better than people are expecting, it's got the ingredients of that, and we'll just have to see. I tend to look at this as a fadeable bounce eventually, but not immediately.
All right, so how should we contextualize when you talk about hedge funds becoming more aggressively short? I guess the common man would think, well, hedge fund money, that's the smart money, the quote-unquote smart money. So how does that play into the analysis?
Hedge funds are just guys. They're not magic. There's a lot of good hedge funds and bad hedge funds. But the imbalance in the market is what's important. There's vulnerability to the upside. There's assumptions being made. And when the orders get stacked up, you have to look at it as a vulnerability, because if that turns out to be wrong, then you're going to see proportionately more aggressive rallies as people have to cover. So whether or not you think the smart money is smart, the short side can never get too crowded. The equities market is big time asymmetric. If this was a currency, it'd be a little different. But you're just not going to win on the short side when you're part of a crowd. There's no way. When the short side gets crowded, it's extraordinarily difficult for the market to go down too much. The market is just too asymmetric. There's just too much long money. You need to shorting is best when you are, very early on in the stage of building a crowd, and then you're covering when the crowd is there. Whether it's hedge funds or anybody else, it's just too asymmetrical market. So, I think that, and again, we're talking about also seeing that there's this bid holding the market up yesterday afternoon, and that you've got too much caution on the part of bulls, which means that can tip back toward a rebalancing point, right? I mean, whatever I'm talking about, when it starts to lean to an extreme, there's just going to be a mean reversion in that indicator. Markets don't necessarily mean revert, but balances of things do. When people are too cautious, when they're too hedged, or when they're too short en masse, you're going to have to rebalance the exposure profile of the market to some extent. And, I think that was probably all things that described the tape on Monday at the lows, when we got the move that I said was, probably the most aggressive tail that we'd seen on an hourly chart in the NASDAQ in 2 years plus. It may be way more, but I can only get data going back that far. So it was, 2.5% in 18 minutes and left that tail down there, that really long tail. So coming off of that, that's probably, the reason why that was so aggressive is because the market was super crowded on the short side. At this point, by the highs today, the NASDAQ's up almost 7% in 36 hours. So that's what you get. And that's a rebalancing move. And I would imagine, given the put call that we see today, that everybody is just mentally fading this bounce so far. There's no belief in it. And I think that, you're going to want to see this hang around, chop around, and then extend a little bit higher. And on the next extension higher, you're going to see that put call start to drop as people start to come up with a narrative that says, hey, maybe this is all just a bad dream over the last few weeks, and we're too hedged. We need to start getting, a more naked long exposure on into year end, just like we talked about last time, because the benchmark could rip without us. And you start to get that dynamic going, and then you start to see that put call on rallies fall way back down. And then, then you start to look at something that maybe is a big fade again, especially if we start to put in a lower high in the market. We work out that short interest. People start to get back involved on the long side, and the market makes a much lower high relative to where it was at the beginning of October. And when you start to roll over from that, maybe you've got a more sustainable potential on the downside.
Outside of what you just mentioned on a technical perspective, not making a new high off that, what are some of the other signals that you're going to be looking at? It's easy to look at the put-call ratio when we're going down, but what are some of the things you're going to be keen on an upside if you are looking to fade?
I would say other sentiment data, especially surveys, as we start to move into the Santa Claus rally time and the holiday market atmosphere, if we start to get some real divergences where we get more, especially if we see divergences, if we see a broad range of sentiment indices start to show, generally speaking, different points of view, but that are all more bullish sentiment than we saw at the highs in late September and October. That if we see that type of divergence, it would really set up that idea. It shows that price is not making a new high, but sentiment is, and that would be probably the best short signal you could get, because that means you probably got speculative interest pushing the market higher rather than something that's a more sustainable form of interest.
And that sounds like a time where you might be keying off that robo ratio, right?
That would certainly be a great tell.
All right, so let's not make it a holy grail, but a nice little rule of thumb when the market's going down and you're looking for a contrarian play. Maybe look at the put call ratio, and on the upside, maybe we use the robo ratio as a good go-to.
Which is a put call ratio, but
right,
yeah,
exactly.
You can see that it is more speculative call bets rather than necessarily just a lack of hedging.
All right. So, do you have a time frame that you're looking at for this one? Is it into the holiday season, or is it something that you're going to be looking at potentially next year?
It could be, very soon, or it could be next year. It just depends on how this pattern evolves. I just need to watch it and just get in rhythm with it and just get a sense. And it could be sort of nested versions of the same thing where we get to an extreme that gets faded sharply. Much like we saw, perhaps, in September of 2015, after the August crash, when we had some sharp pullbacks that did not make lower lows, and we got a base of support. We quickly reestablished overly bearish sentiment on higher highs, so we got the other version of that same divergence. So we might see, for instance, let's say we get a higher high into the end of the week, and then on Monday of next week, we, tank down 2.5% in one day, but we're well off the lows that we made on Monday, and the put call is even at higher levels. That sort of dynamic could kind of give us a foundation of a more sustainable bounce where there's trades in both directions, and so, you can take the short on the way down and the long on the way back, just trying to examine the short time frame patterns if the setups are there. I think that it's a viable two-way market with the VIX where it is. But, I'm not trying to I would never sit here and tell you when I would be putting on a, multi-month short position in the market right now, knowing how little I know about how this bounce is going to work itself out.
Well, and that leads me to the next question, because we do have the VIX still above 20, so I imagine that you're going to be able to find some pretty good trades both ways, both long and short, in the indices.
Absolutely. Yes.
All right. So I think I might have lost you for just a second. Is your audio still?
You hear me?
Yeah, I can hear you now.
Yeah.
All right, perfect.
I just said absolutely to what you just said.
Okay, perfect. Well, let's move away from equities. And as amazing as our rally has been, I want to tell you something that I found even more amazing. How close the crude analysts were to pegging the EIA data storage today.
Well, a broken clock is right, twice a day?
Yeah, well, this is the first time I've seen it in probably 5 years that it's been that close. So
they're
kudos to them.
Forming a broken clock. Yes.
Yeah, maybe they got rid of all the bad analysts and kept one.
There, they just figured it out. This is it. Yeah.
Well, all right. So let's bring crude oil into the mix here. It's had a volatility that I don't know. Is there a VIX for the oil? I think there is. There used to be, at least.
There is. Yes. It's like there's an O in it. I used to watch it quite a bit. Yeah.
Well, as you're looking that up, what I wanted to talk about is the volatility that we've seen, even though it's been in a trading range.
OVX.
OVX. I'm going to write that down for everyone. OVX. I'll add that one to my watch list, and we'll keep it around. I wonder how much it'll fluctuate. We'll do a little live testing of it and see how this thing spikes when the oil numbers come out. It'll be interesting. Anyway, but my point was, we had talked about this in a trading range, and we've been talking about it quite a bit. However, I would imagine that this crude VIX would escalate, yet you haven't really gotten into any trades, even though you've really pegged that zone. Is it just not enough for you? Is that range, whatever it was, $10 to $12 or so, maybe it from top to bottom? Is that just not enough to catch your interest in taking some shorter-term crude trades?
Well, I think part of it is the equities market trading has been so much better. I mean, I've had one of the best months I've had in years for October overall, and really, that's a consequence of the breakdown in the bond short position, but much more the fact that I've had 9 or 10 trades in equity futures that were the home run style trades. So I probably have just become one-track minded about what I'm really watching for setups, and at the same time, the idea of establishing a bias in crude oil for a trading range basically as an outlook was kind of part of me saying to myself that probably I'm not going to be trading that too much for a while. So yeah, that is probably the explanation there.
All right. Well, I do know Commodity Trader has dabbled in that one. So if you are jonesing for crude oil trades, Commodity Trader should be able to bail you out of that one. All right, Chart. So where are we at in the bond market? That's been a pretty interesting market, and I've told you last week I started dabbling back in trading some bonds again.
Yeah. Right. Good. Yeah. I mean, the volatility's there. It's a very interesting market right now, and I think that we're really sitting in an extraordinarily interesting moment for the bond market, because if we are at some kind of point of generally turning towards some cyclical weakness, at least on a comparable basis, for, let's say, other assets and for the cycle, for growth, for the business cycle in general, one would think that would be the process of starting to see interest rates roll back over, right? And the fact that we have seen no real appreciable rally, at least in proportion to what we've seen on the downside in equities, we have not seen a hedge rally in bonds at all. And that's a tremendously interesting thing, because this is what would you do, if you thought the stock market was going to crash in years past? Like, the first thing you'd think is, I'm going to buy lots of bonds.
Right.
That is the trade, and that trade has been put on, guarantee it, by lots of folks with lots of money, and the bond market is not rallying on it, and that is again, by kind of a negative inference, negative space inference, that shows you what's on the other side of that market, is pretty consistently big. And, I think one thing that's on the other side of it is the Treasury. And they're coming into month end here, and they're going to do a refunding size that's the biggest that we've seen since just after the global financial crisis. I mean, the amount of supply coming in now is basically funding deficit projections that it's like we're doing the type of deficit spending that we would do to help the economy recover from a recession. And we have 3.7% unemployment. And that's crazy, because what happens if the cycle rolls over? Can you imagine Treasury supply? Like, we're going to have deficits of $2 trillion at that point. And, the market is not rallying. Bonds are not rallying on all of that kind of, that encroaching percentage of the risk pie. And that's just a little bit disturbing. And I think that's probably one of the big reasons why we saw the violence that we did on the downside on a couple of days in the equities market, again, is because you came into this period, you came into basically the whole second half of the year still without a real unruly kind of breakout in rates, and still with a big risk parity model in place in the market of $500 billion in size. And we talked about it before, but the whole point of that model is that you own stocks and bonds, and you can basically fluctuate the percentages to try to account for varying volatility in the two, so that you're really just looking at a single risk number, but that risk number presumes that the two are inversely correlated to some extent. And when they stop being inversely correlated, especially on the downside, it just throws that model out the window, and you get the big cash raising. And I think that's one of the accelerants that we had in this model, is risk parity people just starting to go from, say, 7% cash to 12% cash or something. And that's because bonds are unable to rally as stocks go down. So it becomes a kind of feedback loop. And if we continue to see this idea that we've seen in a few different aspects of the market. One, if you look at global equities, we're already basically in a bear market. And if you look at the way the banks are behaving, leading on the downside, transports leading on the downside, small caps leading on the downside, chip cycle kind of showing signs of being, in a kind of a bear cycle possibly. All of these ideas, whether or not they're true or not, just if that starts to be reinforced, and we do not see the bond market rally, it's a really interesting signal, because I would imagine there's got to be a ton of people who have moved into a bullish bias on the bond market simply because what's happening going in all of these other markets and inputs in the analysis. And if that doesn't work, then let's just call them, whether or not I can see them easily in the CFTC data, I just intuitively know there's got to be those positions there. And if that doesn't work, then they're going to be selling, and that accelerates interest rates higher and reinforces the same dynamic. And it's just interesting to watch the way that's working out. But either way, I'm continuing to hold the short, because it's coming up against its biggest risk right now, and it's still working.
Yeah, and you can see this on the TLT chart. I pulled that one up for the listeners so you can see it on the visual, and the chart just continues to look weak, and I can't argue against short and bonds still, despite the what you would normally imagine as the flight to safety type move that you would have seen that
right.
typically occurs. With that said, what did you see as the safe haven flows during that sell-off that we had in equities? It wasn't bonds. It wasn't really even yen all that much. Maybe gold?
I guess. I don't know. A cash.
Gold was, I guess cash, but
diversified cash among currencies. I don't know.
Wasn't it perplexing though?
It's very perplexing. But again, I think that this is part of that idea of seeing some of this as less about fear and hedging and more about selling. And so, I think that when you see, particularly the yen rip higher, I think that it's obviously such. I don't know. I don't know how to frame that. Just it's interesting to see such sharp, almost crashy kind of movement in the S&P and not see any instrument that appears to be really obviously acting as a serious safety bet. When you look at how far down equities have come, and you look at, how far we haven't seen moves anything like that even in gold. So there really isn't anything that looks like an obvious beneficiary of the action. I mean, maybe there's some, you could look at some just as rotation out of some of the big tech growth stories and into things like utilities, which have been holding up really well. So, but yeah, I don't see. I mean, I guess staples and utilities are the best answer to that.
Yeah, I would agree.
They're not taking off.
Right. So you said utilities and staples. Usually, though, you'll see some type of asset class outside of just individual sectors, outside of equities, that would respond. And I was hoping to maybe get your thoughts on that, just in case we have another round of selling, another test of those lows and whatnot. But it's really been difficult, and it's been difficult to pin a narrative really on the explanations for why we were selling off. I know coming in every day, I would scratch my head and say, I'd love to have some reason for why we were selling off so big today, but I don't have a good one.
Well, but again, I think they tie together, just as I said. Mm-hmm. We have had, I think that people don't appreciate the importance of what I'm calling the risk parity model, but it really leaks into all sorts of other things. And again, even like robo-advisor allocation for people, they've been marketed well over the years. If you don't need to pay somebody, 2 or 3% or something to make these decisions for you, we have this massive database, and we showed these results over the past 5 years, which is interior to a single market cycle and is useless information, but it's good marketing material. You just download the app on your phone. It makes decisions for you. It tells you how much to have in bonds, how much to have in stocks, how much to have in gold, whatever. But that's all risk parity model too. It's the same thing. And if you start to see that model break, I mean, this is the fact that there has not been a rally in bonds. The fact that bonds haven't been the beneficiary is also causing the further selling, because what people are using as their natural kind of process of hedging against the declines is failing, and so they go to cash. Right? I mean, they end up just kind of backing out because it's not safe anymore. If you have something that works, the market turns, there's an increase in volatility, but you've got something else in your portfolio that starts to outperform, which counteracts those losses and makes you feel comfortable that you can continue holding things the way that you are, then that's a great feeling. But if a week goes by and it's not working, and you're taking big losses, and you're seeing a major drop in your total account value, then you start to get scared and you start to sell everything and you go to cash. And that's what's on an institutional level, that's happened in the form of big risk parity fund managers moving up their cash levels. But it's also, I think, happened on the level of just, how people are managing their retirement accounts and things like that, because their basic assumptions about how their money is being allocated and how, that they have some kind of protection or safety if the market does something weird, that's starting to be challenged. And so I think that that's kind of a psychological feedback loop, and is in part responsible for the degree of selling that we've seen.
All right. So what's the next big event that you're looking forward to in the markets that'll help you form or postulate what you're going to do on your next big trade?
I mean, I guess Apple a little bit, just to see. We've had a process this earnings season of kind of like really two types of signals. There's been good signals. There's been bad signals about the fourth quarter and about where we are in the cycle. And, you can look at something like AMD versus Intel, just completely different kind of outlooks and looking ahead to the fourth quarter. Texas Instruments, or, they're just, one of them is saying, well, this whole thing that we've been doing for the last couple of years is over. And the other one's saying, no, it's not at all. And I think that people say that earnings input is really over because we got Google and Amazon, and they're down a bunch, and it's just the guidance was dropped for the fourth quarter, and that tells you all you need to know. But again, we could have a resetting of that narrative if Apple comes out with something completely different. It's unlikely, simply because Apple could also, and they like to do this, I think, kind of sandbag a little bit.
Yeah.
And especially just kind of set up a situation where, well, especially they can get away with it now. I mean, they can lower everybody's expectations and then go flying over the lowered bar next quarter, because people are making assumptions now. It's not going to be shocking if they lower things a little bit, because, Google and Amazon, Netflix, and everybody else did too. So, they can get away with that and make it very easy bar to jump over next quarter. And so probably they're going to take advantage of that. I mean, that seems to be their kind of a historical bias in these types of situations. But Who knows? I think it's going to be interesting to get a sense of, like, that's down to, like, the last piece of information that really says, is there an inflection that's happened? Because there are other companies that have come out and have suggested that a genuine inflection has happened at this point. And that's particularly worrying if true, and one of the reasons why I would generally be expecting to fade this bounce at some point is, as I said, I think that the big problem here, if there's a big problem underneath all this, there is a cyclicality, there is a business cycle, there is a market cycle. There really is. It is an oscillation from one end of a spectrum to the other, where the ends of that spectrum are defined by risk aversion on the one hand and risk acceptance on the other. And you will inevitably get to the point where there's been too much risk acceptance, too much hiring, too much spending. People are getting ahead of themselves, building up too big inventories. People are borrowing too much money. Banks are lending too much money. It's all part of the same kind of evolution of big picture cyclical movement, and that's really the driver. And at the other end of the spectrum, when people are hiring too few people and storing up too little inventory, and borrowing too little money and lending too little money, all that defines the bottom end of the spectrum. And we do kind of herd along the spectrum back and forth. And if we've gotten to a point where, there's a cyclical vulnerability, and particularly worrying, and then if we essentially, fiscal stimulus at the point that we did it, I love circus metaphors. So, I'll go back to the acrobats or the trapeze artists. The trapeze artist with a safety net underneath. Let's say we figured out we could get the trapeze artist to be pushed higher in the air by generating enough heat. And the way that we generated that heat is we set the safety net on fire. And it really catapulted the trapeze artist even higher in the air. That's kind of like, I think, doing a big fiscal stimulus program with 3.7% unemployment. That's just like you not only maybe encourage a risk acceptance movement on that spectrum that gets you to the extreme you want, but then you also take away your device for countering the movement in the opposite direction when that momentum peters out. And that, I think, kind of is one way to look at where we could be right now, which would be the worrying view, and kind of something that I've been entertaining as an idea, because, again, the Fed's just got a couple cuts in it. We're at 2% pretty much, and it goes down a lot faster than it goes up. They're not going to go tiny little moves down. If we start to see some real problems, they're going to cut by, 75 basis points and then another 75, and we're going to be pretty much done. And then you've got QE, which everybody really doesn't, at this point that was a psychological impact to that, and that, became a law of diminishing returns kind of process over QE1, QE2, QE3, and we've seen Japan go into a second cycle of QE and it did nothing. So there's really not much in the way of bracing tools in the other direction, and if we're coming into that process with the possibility of moving to $2 trillion deficits in a recessionary type environment, like that's, whether or not any of that comes to pass, that risk is on the table. And so I think that that's probably why you're seeing, 3-year record short interest from hedge funds. That's the reason. But it gives us a chance for a bounce when everybody gets crowded too much. There's a rhythm to the thing. It's tough for me to see. Maybe we will have that next, we light something else on fire and the acrobats go even higher. Or the trapeze are, float up even higher. Like, it's possible to keep that process going, and I don't know if we're going to be able to do that or not. But, I don't know what your question was even at this point, but there's my answer to it.
All right. Well, how about... I forgot it as well. But I liked your answer.
All right.
Sounds like a whole lot of hot air, right?
Yeah, could be.
There you go.
Could be.
All right. So one last one I want to talk to you about is your current thoughts in the gold. We had that setup, and you really did pin it. You maybe were a little too tight technically on that stop, but for the most part, you were right. And there may be some people out there still that are involved in that gold long, and so far so good, really. Has your perspective changed on gold? Is the CFTC data indicating anything has really changed?
So, my perspective changed just from the sense that I really did not want to see the initial move higher be inspired by what I would call catastrophe hedges. And so it's like we were talking about with the basic idea of what's the beneficiary. It kind of looked like gold was, if anything was the beneficiary, it was maybe gold. So I just from a mode standpoint, like I feel because that was the reason. I didn't want to chase the move once I got shaken out. If it had started to move like that without it seemingly being in response to a sharp decline in equities, I probably would have chased it. And so that made the difference in terms of how I behaved there. As far as the CFTC data, it's changed a little bit. We're out of net short position for large speculators, so that's healed a little bit, but it's nowhere near back to where it tends to get to. I mean, I think it's about 30,000 net long right now, and maybe close to 50,000 when you look at the large and small together, but it gets up to 200,000-300,000. So we have a small net long position that could easily be something that extends quite a bit if we're not in the context of a bear market in gold. One of the problems I have with it also is that I have become bearish again on the euro quite a bit, and that's something else that I'm kind of like, if we get a sharp headline-driven bounce in the euro, that's probably a trade that I would be putting on, simply because, as we talked about last time, I believe that there is an underappreciation of where the Italy situation is going to escalate to, and I think that it will necessarily get to a point where we've got a Brexit-like situation for Italy, where there's negotiations about, even though nobody wants to do that, again, there are two entrenched sides that are entrenched for reasons that they don't have full control over. There are forces, the predication of the power complex in Italy right now is essentially, it would not allow them to give in, and yet there is no chance that Brussels can give in, and they're miles apart. So, there's a showdown here. It's a once and for all, we're going to solve this thing. To Brussels, they're looking to put a head on a stake to make sure that nobody in the village tries to do the same thing again. And for Italy, this was a revolution politically for them, and they're trying to do the same thing. And so I think that the outcome of this will define and reduce the impact of similar situations like this in the future. But the outcome of this is not going to simply resolve itself tomorrow and in an amicable manner. There's, I think, much more escalation to come. And so if I believe that, then it's hard for me to want to enter a lot of strategies that are dependent upon a weak dollar, because the dollar is going to be defined by what the euro does. And if the euro is starting to trend down and is about to drop through its August lows, as this starts to escalate, and again, hopefully I get the bounce to be able to figure out how to put that on, but I need to be able to get a risk-reward and a falsifiability in the pattern, as we've talked about a lot. But the bias for me right now is downside in euro, which means by default upside in dollar. And so, again, you have this issue. Gold typically is inverse to the dollar. It doesn't always have to be, but that's a little bit of a check against wanting to just barrel into gold on this pullback.
All right, I was pulling up a euro chart just so people could have some perspective here. And let me expand it for everyone. I have a weekly chart up in the euro. Looks like we're testing the 200-week moving average in the euro, but I do
and
see...
also the August lows.
Okay, right, yep, exactly. Yeah. The August lows right there. Hopefully people are able to follow along with this one. I know my sometimes my futures charts aren't the best here, but it looks like I got the continuous one up there. So you're looking at a potential low, a breakdown, and
you'll see on your chart that if you put a horizontal line across the lows from August and the low we're at now, it's also a good, especially on the weekly chart, it's a very visible top of the range from 2015, 2016. So this is a big level.
Yeah, make or break area.
Hopefully, it inspires a bounce, and that bounce is attached to a headline that will allow us to fade it, probably at small size with wide risk, to eventually play for a move down to maybe 110, a break under that level. And again, I think as things escalate further than people maybe, I think there's just an ingrained level of complacency, and you see it in credit default swaps too. It just isn't, I think, an appreciation of how necessarily serious this will get.
Alright, well, we're currently trading, just to give the listeners some perspective, in the futures here, 113.60 right around now, so that's at least, if it gets down to that 110 area, 350 points or so, 300, depending on where that breakdown level would be. Probably, I would guess, like 113 even-ish? Sound right?
Where the breakdown would be, like the trigger level?
Yeah, the trigger point to the downside.
Yeah, 113 is as good as anything, yeah.
Yeah. Okay. All right, well, we'll definitely keep an eye on that. As far as any other markets that are catching your attention, anything else out there?
Let's see. I mean, obviously, China kind of interesting, not making new lows here on this latest climb. Said it was a fadeable bounce when we saw the bounce initially, because it seemed to be so inspired by, government commentary. And it faded down quite a ways, but didn't make a new low. Started back higher now, so that's kind of a little bit of a divergence with the U.S. equities market in a positive way for China. So it's a little bit interesting. Banks held up even during the decline the other day, Monday, way off their lows. And that's, again, another divergence that, you've got the things that led this decline. China first, banks second, making higher lows as the market makes lower lows. So that's a little bit interesting. Corporate debt is, just really kind of it's starting to become the main focus of the bears probably. You just look at LQD, it's just getting crushed day after day after day. And this is heading into what we talked about. 2019 is going to be basically the biggest corporate debt rollover period in a long time. And you're doing it at much higher rates. And so that's kind of a lot of supply and a worse pricing standard. And so that's probably explanation of why you see even investment-grade corporate debt really getting hammered. As far as trading, I'm still really focused mostly on equity futures, and just, maybe even adding to the bond short is a possibility, given the way that it is failing to rally on this the volatility in equities, and then also looking to potentially short a bounce in the euro. So that's pretty much my focus.
All right. Well, I think that's enough to chew on. However, a couple more days like this in the equities, and we'll be back down 14 VIX in no time, right?
Yeah, but again, I think that's going to be your low.
I was just kidding.
That will be interesting.
I was just kidding.
That's a beautiful thing. At least it's not 9.
At least it's not 9. Hey, if we can stay between 14 and 22 for the next 10 years, man, we'll all be doing well, I think.
I'm saying that's a beautiful thing.
It is a beautiful thing. Hopefully we can get it back there. All right. With that said, I think we will. The last thing I did want to ask you: when's your chart book coming out?
It's probably just after the weekend.
All right. So we'll look forward to that. Key themes are
everything we've just talked about, and just kind of exploring them more and putting them with charts.
All right. Well,
and if I think everything changes as I start to do it. Generally speaking, it's how I form ideas. So I come in with a lot of ideas, and then they get tested against the process of me thinking about them a lot more and comparing them with charts.
All right.
And figuring out if I've got something off.
Sounds great. Well, then you can pretty much count on you being back on next week to discuss those, and we'll break those down further and see if you have any new ideas. As always, thank you so much, Brett. Enjoy the Halloween with the kids.
All right. Thank you, Jim.
All right.
Take care.
You too.